Hey everybody, welcome back to the show. So as you may know, not everyone pays the same amount of money for Medicare. In fact, depending on your income, you may be paying hundreds of dollars a month more than your neighbor. It's called IRMAA, which is Income Related Monthly Adjustment Amount. I know it's a mouthful, but it basically just means if you make a certain amount of money, the Social Security Administration is going to charge you more for Medicare, specifically Part B, but also Part D, which relates to prescription drugs. So what we're going to do in this video is first we're going to walk through how IRMAA works, because it's really important to understand that. For the second part of today's video, which is discussing some strategies, and even I'm going to show you some software that you might use to work to get those IRMAA payments lower. And believe it or not, there's even one strategy that involves simply asking. That's right, you can ask the Social Security Administration, hey, lower my IRMAA payments. There are certain circumstances where they will actually do that. So that's what we're going to cover in today's video. As always, I'll link to everything I'm showing you on the screen, and we'll start here. So what we're looking at are the IRMAA brackets for 2025. And let me see if I can make that just a little bigger. So you can see they have three different columns for your different tax filing status: single, married filing jointly, and married filing separately. And then you find the column that applies to you. We'll just look at married filing jointly. And if you make $212,000 or less, and I'll talk about what that means and how that's calculated. It's really important. But if you make $212,000 or less, you pay the standard premiums for Part B and D. We'll just focus on Part B for the video today, but that's $185. Now, if you make more than that, you make between these two amounts, it jumps to $259, and we can go all the way down. If you brought in, that's a lot of money, but $750,000 or more, your premiums will have jumped from the base rate of $185 all the way up to $628.90. So there's a lot of money. And remember, these are monthly charges. So you multiply that by 12, and that tells you we're dealing with a lot of money. Now, we need to understand how this number is calculated. So it's a little tricky for two reasons. Now, first, we're in 2025. Where does this number come from? Because they set these rates before our tax returns for 2024 are due in 2025. And so what they do is they look at your most recent tax information, which most of the time for most people would be 2 years earlier. So in 2025, they would typically look at your 2023 tax return. Again, you probably haven't filed your 2024 tax return when they need to calculate all of this. So they go back, in most cases, 1 year or 2 years from the premium year. So again, from 2025, they go back to 2023, assuming that data is available for you. So that's the first thing to keep in mind. The second thing is, what they do is they use what's called a modified adjusted gross income. So they take your adjusted gross income, which shows up on your 1040, and they make one adjustment to it, and you can actually see it right here. They take your AGI, your adjusted gross income, and they add in any tax-exempt interest from line 2A, if you want to know the exact line of IRS Form 1040. AGI is found on line 11. So that's two things to keep in mind. They're going to go back 2 years for the data, and they're going to use a modified adjusted gross income amount. Now, for a lot of folks, it might just be their AGI, but if you have tax-exempt interest, they will add that to AGI to arrive at your modified adjusted gross income. Now, before we dive into some strategies to maybe keep IRMAA payments lower, or maybe even eliminate them altogether, there's one other really important thing we need to understand about these brackets. For a lot of tax issues, there are phase outs. If you make over a certain amount, the tax credit or the deduction or whatever it might be begins to get smaller and smaller over some amount of income, and then it phases out completely at a certain range. That's not how IRMAA works. If you go over the low end of a bracket by even $1, you pay the higher amount for that bracket. So for example, if two people, one person had a modified adjusted gross income from 2 years ago of exactly $212,000, they'd pay $185. If their neighbor had modified adjusted gross income, again, both married filing jointly, of $212,001, because maybe they made $1 of savings account interest or something, they jump to here and they pay that higher rate, $259, for 12 months in 2025. So going over by even $1 makes a big, big difference. And we have to keep that in mind as we think through ways that we can manage our modified adjusted gross income to try to stay either completely out of any of these additional charges or in as low a IRMAA bracket as we possibly can be. So what are some of the strategies? I'm going to walk through about 8 things. Some are more general, some are very specific. So the first thing is it's important to take a long-term view of managing IRMAA. We could certainly do things, let's say in early retirement, when we start getting Medicare, or even at 63, right? Because that's the tax year that they would first look at 2 years later when we sign up for Medicare. We could, for example, take our spending money out of a Roth to keep our taxable income down, or maybe out of a taxable account that doesn't trigger a lot of taxes. And that might help us in the early years of retirement. But perhaps when required minimum distributions kick in our 70s, we might get walloped then with taxable income and end up in higher IRMAA brackets for the rest of our retirement. So it's important to think about managing the costs of Medicare and these IRMAA payments throughout the entirety of your retirement plan, just not your first few years. Let me just show you visually what that looks like. We're looking at Boldin. This is one of the retirement planners that I use and like a lot. And this is a demo account. And you'll notice under Insights, they have a whole section on IRMAA. It's right here. Again, this is based on a demo plan that I just entered. You can look at the overview here. Again, it's made up data, but I tried to make it somewhat realistic. And we can look at IRMAA. So we can see the brackets. They rounded the numbers, but these are the brackets for married filing jointly. They put that in the program, and there's for single filers. And then they actually track for you your modified adjusted gross income. Again, if you have significant tax-exempt interest, it may not get captured here, so you want to keep that in mind. But they track your modified adjusted gross income. And then they track your IRMAA payments. So in this case, this hypothetical retired couple had 3 years of IRMAA early in retirement, and then 1 year at the end of their plan. So you can see not only the IRMAA payments over the entire retirement plan, but as you make changes to your plan, and we'll talk about some you might consider, you can see the effects of these changes right here. The other tool that I like a lot is Projection Lab. I know if you're not familiar with it, this looks like a very busy screen. But we're simply in the tax analytics section. We're looking at taxes, and it's the bright orange. We can just hover over it. It may be hard to see. The numbers are a bit small, but when this hypothetical couple, they're 81, they'll owe $5,266 in IRMAA payments, and that's over and above the $4,400 they'll owe in base Medicare. So these programs can track this for you, and I think it's a very useful way to understand IRMAA and again, work to possibly make changes to it. So how do we do that? How do we manage our income in a way that might help us with the IRMAA payments? Well, this gets us to point number 2. One approach are through Roth conversions. So that's when we take, say, money from a traditional IRA that will eventually be subject to required minimum distributions when we get to that age, 73 or 75, and we move it over to a Roth account. Now, of course, when we do that, the year in which we make that conversion, the amount we convert is going to be treated as ordinary income. So right there, we have to be concerned. Will the Roth conversion itself trigger additional IRMAA payments? That's a question we have to understand and think about. If it does, it doesn't necessarily mean the Roth conversion is a mistake. Remember, IRMAA is just one of the taxes that we have to deal with in retirement. It's important, but it's not the only one. And we always want to take a sort of a big picture approach to our tax planning and retirement planning, because maybe spending a little bit of money on IRMAA payments early in retirement could save us even spending more money down the road when required minimum distributions kick in. But Roth conversions can potentially help us manage that, because as we convert more money to Roth accounts, yes, we pay the taxes at the time of conversion, but that lowers our balance in our traditional retirement accounts, which will reduce our required minimum distributions when we reach that age in our 70s. And what a lot of folks do if they retire early enough is they'll do Roth conversions before they're 63, before the amount of their modified adjusted gross income matters for purposes of calculating IRMAA, and that can be a great strategy. The other thing they might do is, sort of bite the bullet and do some larger Roth conversions for just 1 year, maybe 2 or 3 years. Yes, that might trigger, depending on your circumstances, some additional IRMAA payments. But it could save you a lot down the road because it's lowered the balance in your traditional accounts and therefore reduced your required minimum distribution. I'll show you one thing in this software, specifically Boldin. It has a Roth Conversion Explorer. It's right here. And one of the things you can do, you can test IRMAA brackets. You can say, well, you know what? I want to do Roth conversions, but I don't want to do so much that it's going to put me in any IRMAA charges. You'd select this one. I'll go back. Or maybe you'd say, well, I can't avoid them completely, but I don't want to go above this one, right? So you have those choices. We'll select the lowest one. We'll say we don't want IRMAA charges at all, and whether this will actually generate any, I don't know, because it just depends on this plan. We'll see. So it did. It optimized some. It suggested some optimized Roth conversions, and it will show you the effects of your overall tax liability, but also your IRMAA fees. And so it kind of worked out. It does still have some early on, but then for most of retirement, there are none. So again, you can use tools like Boldin to do that. You always want to check the data yourself and think about it from year to year as you make choices. But Roth conversions can be a great way, honestly, not just to manage IRMAA payments potentially, but really all of your tax payments, smoothing them out over your entire retirement plan. Can help out a lot. All right, number 3, we could do some tax loss harvesting. So if we have some losses in our taxable account, we could go ahead and sell those securities at a loss. We wouldn't want to invest back into them right away. We want to think about that 30-day wash sale rule. We could invest in something different if we didn't want to wait 30 days. But those tax loss harvests, when we tax loss harvest, it gives us 2 potential benefits. So one is we can offset other gains with those losses, and we can carry those losses forward. We don't have to use them all in the year in which they occurred. So that could help us perhaps generate spending money in later years that either aren't taxed at all because the losses would offset those future gains, or it could just reduce our tax liability. Also, we can take tax losses and set them against up to $3,000 of ordinary income. Now, it's not a huge number when we go back to these IRMAA brackets, but remember, going over one of these brackets by even $1 can trip us up and send us into one of the higher numbers. So it's possible that a $3,000 offset from ordinary income with tax losses could move us into a lower IRMAA bracket. It's just something we'll need to calculate. And I will admit it is tricky, right? Because as we're thinking about 2025 and what our modified adjusted gross income will be, we don't yet know what the actual IRMAA brackets will be in 2027. We can kind of guess. They're adjusted for inflation, but it gets really hard to nail this down to a specific number for each level of each bracket for IRMAA. And yeah, we just have to do the best we can, but tax loss harvesting might be able to help us. All right, number 4, we could do what's called tax gain harvesting. So maybe you have some taxable investments with some gains, but because of your tax situation in a given year, you can recognize those gains and potentially pay 0% long-term capital gains tax on them. And so what some folks will do is say, that's great. I'm going to recognize those gains right now. I might turn around and reinvest the money, but I've effectively increased my tax basis without paying any taxes so that when I go to sell them next year or the year after for spending money, my tax bill will be a lot lower, and that, of course, can help us manage the IRMAA brackets. So tax gain harvesting is just sort of another tool in our toolbox that, if the circumstances present themselves for you, something you want to think about. All right, number 5, asset location. So that just means putting the right investments in the right type of accounts to reduce tax liability. So specifically in taxable accounts, I tend to avoid including investments that generate a lot of taxable income every year. That could be a lot of interest, a higher than normal level of dividends, or even, say, actively manage mutual funds that might generate a lot of short-term and long-term capital gains, even if you don't sell the shares of those funds. And so I want to make sure that in my taxable account, we're using very tax-efficient investments, because that will reduce my overall tax bill. Of course, helps us potentially manage IRMAA, but it helps us just with taxes even more generally. So I think it's a smart thing to do, even if IRMAA is not an issue for you. All right, the next thing to think about, number 6, are qualified charitable distributions. These come out of your IRA when you've got to make your required minimum distribution. You can actually take some of that money and give it to charities, and it can serve as part of, or in some cases all, depending on the amounts, of your required minimum distributions for that year. I point this out because if that's your plan, if you plan to make qualified charitable distributions, you want to factor that in. That effectively means that your taxable required minimum distributions will be lower than if you didn't make those charitable contributions. And so that needs to be factored in with everything, including Roth conversions, whether you should do one or not, because often you're looking at the tax consequences if you don't do a Roth conversion when your required minimum distributions start. But those tax consequences are going to be less if some of that, or maybe even all of your required minimum distribution, is going to go to charity. So that's definitely something that you want to consider. The 7th thing, and this is the last one before we get to number 8, which is ask the Social Security Administration for a lower IRMAA amount. Number 7 is you could think about delaying taking Social Security. And I think this can be a good approach for a lot of reasons, not just IRMAA. But if some folks have determined, I'm going to wait till I'm 70 to take Social Security, at least until Social Security starts for you, that's just less income that you have. And during that time, you might just enjoy lower IRMAA payments, or maybe none at all. Or you might use some of that room for Roth conversions as another example, or some combination of the two. Now, of course, you have to be mindful that once Social Security does start for you at age 70, the amount's going to be higher than if you had taken it earlier. That's, in fact, one of the probably primary benefits of waiting in the first place. So again, that kind of gets me back to the very first thing I said. You got to take a long-term picture of this. And by the way, software like Boldin and Projection Lab, which I'll link to below this video, both of them can handle that kind of analysis. You can set up in both packages when you're going to take Social Security, the amount, and how that affects your overall plan. And again, it'll show you how it affects your IRMAA payments as well. All right, number 8, I got to be honest, this was new to me. I didn't know about this until I did research for this video. I will show you the actual form. Here it is. This is from the Social Security Administration, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. If you have a life-changing event, I'll tell you what that means in a minute, you can actually apply to the Social Security Administration for an adjustment to IRMAA. And I'll leave a link to this form. And if we scroll down, I think it's page 5. Let's see here. Maybe. Here we go. Here are, I think that's all of them. Yes, here are the life-changing events. Actually, marriage is one. That's certainly life-changing. Divorce, death of a spouse, issues with work, loss of income-producing property. You can see them here, loss of a pension. So there are a number of life-changing events that if you experience, they may qualify you to get a lower IRMAA payment. And so again, something to think about. I will leave, as I said, a link to this below the video. And then finally, I will also link to this. So I, just a week ago, started a Reddit, a subreddit forum. I call it Do It Yourself Retirement, a DIY retirement. It's been wonderful. There's already, 1,700 members. We've had almost 45,000 people visit in just a little over a week. And so this was just something I put together just at a high level, the things to think about with IRMAA. And then, of course, the folks that are already members had some great comments. You'll find other tips and suggestions in here that I didn't come up with that you might want to check out. And so this has just been a great community of folks. You're welcome to join it or just visit and stop by. But I will leave a link to this particular conversation below the video. So there you go. IRMAA, it's a big deal. There's a lot of money at stake. The cost of Medicare, depending on your income, can go up substantially. And so it's something that you want to think about and plan for as best as you can. So again, I'll leave links to everything I've mentioned in the video. If you have questions, leave them below the video. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.